Imagine starting with just $2,500 and turning it into 50 million bucks. Or, picture a bellhop in the Czech Republic who somehow outtrades 99% of professional Wall Street hedge funds.
I mean, it sounds completely impossible, right?
Right. But the secret to beating the pros wasn't like some fancy finance degree. It was actually tracking online chatter about Elmer's glue.
Which is wild. It completely turns the traditional idea of market expertise, you know, upside down. And that's exactly what we're looking at in today's deep dive.
Yeah, we're getting into Jack Schwager's book, Unknown Market Wizards, and the mission here is really unpacking how he hunted down these obscure solo traders who just totally bypass Wall Street.
And still managed to crush the professionals.
Exactly. We're going to figure out exactly how they do it.
Well, let's start with Jeffrey Neumann, right? His entire strategy relies on what we can basically call social arbitrage.
Okay, let's unpack this. Social arbitrage.
Yeah, so while traditional analysts were, staring at spreadsheets predicting these dismal earnings for Netflix, Neumann was tracking something called conversational volume.
Wait, conversational volume? Like just people talking?
Yeah. What's fascinating here is that he relies on this boots-on-the-ground reality, totally bypassing traditional financial models. So instead of earnings reports, he was looking at the sheer velocity of people talking about the show Stranger Things online.
Oh, wow. So he's measuring the intense emotional engagement and like the sudden spike in real-world cultural chatter.
Exactly. He wasn't just counting casual mentions. He just looked at what consumers were actually doing.
It's kind of like spotting a high school fashion trend months before it reaches the mall. You don't need a quarterly earnings report to see everyone is suddenly wearing the exact same sneakers, right?
That is a perfect analogy. And he did the exact same thing with Elmer's glue.
Right, the glue.
Yeah, he noticed it was quietly selling out in stores everywhere. And why? Because kids were suddenly using it to make DIY slime.
That is so crazy. So he bought the stock before traditional analysts even knew what slime was.
Precisely. So Neumann finds his edge by figuring out what the crowd secretly loves. But then there's Jason Shapiro, another trader in the book, who goes the exact opposite route.
Okay, so he finds his edge in what the crowd is absolutely terrified of.
Yeah, and trading against the crowd is brutal. I mean, Shapiro actually wiped out his entire account twice before he learned how to properly fade market euphoria.
Fading? That just means systematically betting against the overwhelming public consensus, yeah.
Right, exactly.
Yeah.
And to do it, he relies on the Commitment of Traders Report, or the COT.
Oh, I've heard of that.
It's this weekly publication that shows exactly where different groups are putting their money. Shapiro uses it to track the commercial insiders.
Like the people actually producing the stuff?
Right, versus the panicked everyday speculators.
Here's where it gets really interesting, because I want to push back on this a little bit. You're saying he buys when there's objectively terrible news and all the everyday speculators are panicking?
Yep.
But how can terrible news actually be a buy signal? That feels completely backward.
I know it sounds counterintuitive, but it all comes down to market participation. Think about a huge panic sell-off. If every single easily spooked investor has already panicked and dumped their shares.
Oh, I see. There's literally nobody left to drive the price down any further.
Exactly. The bad news is already fully priced in. Once everyone who wants to sell has sold, the price can literally only go up.
That is brilliant. But reading through these sources, there's a really brutal reality check here. Spotting trends and fading crowds is totally useless without the final ingredient, which is just raw survival.
Yeah, which brings us to Peter Brandt and his extreme risk management. I mean, he literally calls himself a glorified order enterer.
A glorified order enterer. I love that.
Right. If we connect this to the bigger picture, his approach to risk is so intense that he only risks 0.5% of his total equity on any single trade.
Wait, 0.5%. So if he has like $100,000, he's risking a maximum of $500 on a trade.
Exactly. That means he can be wrong 10 times in a row and only lose 5% of his capital. And he actually takes profound pride in being wrong 10 times in a row.
That is wild. Most of us hate being wrong even once. Like, our egos just can't take it.
And that's exactly the secret. Success isn't about intellectual prediction. It's about killing your ego to preserve your capital.
Right. Losing is just a mechanical part of the process, not a personal failure. So what does this all mean for you listening right now? You really don't need a finance background to apply this stuff.
Not at all. Whether you're a music major, a bellhop, or just trying to protect your savings, success is about finding a process that fits your personality.
And rigidly protecting your mental capital.
Exactly. Market opportunities exist simply because human emotions never change. The technology might evolve, but fear and greed stay exactly the same.
So true. So instead of searching for some complex financial formula, we'll leave you with this provocative thought to mull over. What current societal euphoria or panic are you blindly participating in right now?